Goldman Sachs Global Head of Commodities Research, Jeff Currie. Jeff, great to have you on the show. Let's start first with this report that you've just put out. $100 a barrel. That's still a lot higher than where we are right now. Walk me through it.
Well, our bullish forecast for 2023, really driven by the reopening of China next year. While the confidence remains high for that, the path between today and then, highly uncertain. Particularly given the rising cases in China, the big fear right now is a forced reopening, similar to what we saw in Hong Kong as well as Taiwan. The concern there is, right now, infection rates are at April 22 levels, where they were this last April when you lost 2.5 million barrels per day of demand. The fear is we do not know the policy reaction function. Caseloads go higher. The concern is they overwhelm medical facilities, and then you get self-imposed lockdowns and a collapse in demand. Now, while that would be forced reopening means a lot of pain near term, and as you reach herd immunity, you'd see a rebound in activity. And if we looked at forced reopenings around the world, it typically takes about a quarter before that activity really begins to rebound significantly. But at this point, again, I want to emphasize a lot of uncertainty. We still believe in the higher prices in 2Q of next year. But I think the key point here, why the viciousness of the downside right now, the trend lines have been broken. There was link to get rid of the market. The CTAs are short. All of that creates some tactical near-term downside risk. But I want to emphasize there's a lot of uncertainty. One last point on, OPEC. I think, kudos to OPEC for preempting this demand loss as the very first time in the history of OPEC where they actually preempted a demand decline, but I think there's a lot of uncertainty. Our estimates of the demand decline right now is 1.2 million barrels per day, not as big as what it was back in April. But at this point right now, it's about the same size as the OPEC cut. This is why we see it coming back up.
Okay, but I've got a little bit of whiplash here where OPEC's concerned, because we do have these headlines, and I know that they're meeting on December 4th, so soon. These OPEC headlines that the cartel could consider a production hike in December. Why? Why the change so quickly?
Well, the question is, how quickly the pullback is. I think the key point there is, what do we see happens with the G7 price cap? Because what we have seen right now, and part of adding to the downside price risk, is that the Russians are dumping a lot of oil on the market right now. And we look at inventory at sea, it's up 25 million barrels. So they're trying to get as many barrels into the market before the price cap and ban goes into effect on December 5th. Which is, again, putting downward pressure on the market. Now, we only think that's worth 300,000 barrels per day. So China worth 1.2 million barrels per day. The Russian excess supply being pushed on the market early worth 300. So the total hits about 1.5 million barrels per day. By the way, today, the market's pricing in a 2 million barrel per day hit, much bigger than that. But I think the key point is that once that oil pushes through the system out of Russia, that oil's at sea, you're going to start to lose another 300,000 to 400,000 barrels per day, which could leave more room for OPEC. But I think, the key point, that cut that they implemented in November equals about the offset loss in demand out of China. And there's a lot of uncertainty around how long that's going to last.